Welcome to The Explainer. Let's break down what happened in the U.S. markets on Tuesday, November 11th, 2025. This was one of those days that sent completely mixed signals and, honestly, left a lot of people just scratching their heads.
So get this. On the surface, the market was just completely split down the middle. You had the Dow Jones, the index with 30 of America's biggest, most established companies, soaring 1.2% to a brand new all-time high. I mean, fantastic, right? But at the very same time, the tech-heavy NASDAQ actually dropped 0.5%. It was like two totally different stories being told on the same day. Just a really severe division. And that, of course, brings us to the big question. How is that even possible? How can one major part of the market be celebrating a record high, while another is flashing some pretty serious warning signs? Let's dive in and unpack the powerful forces at play here.
All right, to really get what happened, we have to start with the story that's been dominating everything for months, this incredible, almost relentless optimism around artificial intelligence. This is the bull case.
The sheer scale of the investment here is just staggering. We're talking about a projected $600 billion in capital spending on AI infrastructure every single year by 2026. This isn't just hype or talk, it's a massive, massive financial commitment from the biggest companies on the planet, all betting that AI is about to unleash a historic boom in productivity.
And that insane level of spending is exactly why you hear influential voices, like BlackRock's Rick Rieder, arguing that this is completely different from past tech bubbles. He's basically saying, look, unlike the dot-com era, which was built on speculation, this AI rally is built on a solid foundation of real cash and real investment. For the bulls, the money is real, and it's already being put to work.
But on this particular Tuesday, that solid foundation started to show some pretty serious cracks. And suddenly, the bear case, the argument for being cautious, got a whole lot louder.
Two things in particular really spooked investors. First, SoftBank announced it sold its entire $5.8 billion stake in NVIDIA. Now, the official reason was that they're just reinvesting in other AI companies. But you know how the market reads between the lines. The real message people heard was that a major smart money player thinks the stock might have finally peaked. Then, an AI infrastructure company called CoreWeave cut its revenue guidance because of project delays. That's a huge red flag, pointing to real-world bottlenecks.
And if that wasn't enough, famed investor Michael Burry, the big short guy, threw gasoline on the fire with this really sharp critique. He's basically alleging that the way big tech companies account for their AI servers is essentially inflating their profits. So now we're not just talking about high valuations, we're talking about an accusation that the earnings themselves might not be what they seem. And the worries weren't just about AI. The broader economic picture started to look a little gloomy too. The ADP report showed private payrolls are actually declining, which is a big sign of a weakening job market. On top of that, the Small Business Optimism Index hit a 6-month low. So it seems like the real everyday economy is starting to slow down.
So, what happens when this unstoppable force of the AI rally slams into a growing wall of fear and bad data? Well, investors didn't just panic and run for the hills. Nope, they rotated. They started moving their money around looking for safety.
And this rotation created what we call a K-shaped market. You can see it right here. Money poured out of the high-flying risky tech sector, which fell about 0.75%. And where did all that money go? It went straight into safer, more defensive sectors like healthcare, which jumped a full 2%.
And because the Dow Jones is only made up of 30 of these huge established companies, many of them in these exact defensive sectors, that rotation was powerful enough to push the entire index to a new record. A huge part of this was the strength in healthcare giant Eli Lilly. Investors just flocked to it, looking for its strong, steady business and perceived safety.
This kind of split market creates a real dilemma, right? And it really leads to two very different playbooks for how you might navigate this kind of environment.
So you're left with two pretty clear paths. The aggressive strategy is to say, hey, I believe in AI long-term, so this dip is a buying opportunity. You might look at ETFs like MAGS or ARQ. The massive risk there, of course, is what if the AI bubble completely collapses? On the other hand, you have the conservative strategy, which is to hedge against that risk and focus on defensive stocks, maybe through an ETF like XLV for healthcare. The risk here, well, you could miss out on some truly huge gains if that AI productivity boom turns out to be the real deal.
Okay, so after a day that was just full of conflicting signals, let's try to boil this all down into one clear summary and, more importantly, identify the key risks that every investor should be watching from here on out.
Here's the story of the day in a nutshell. The most positive thing?
the market's resilience. Investors didn't freak out, they just shifted capital to safer places, and that was enough to lift the Dow to a record. That's pretty impressive. The biggest negative? The fear of an AI bubble is no longer just chatter. It's being fueled by actual events and some very credible criticism. It feels a lot more real now.
So looking ahead, this leaves us with two major risks to keep on our radar. First is what you could call structural inflation. Think about it. The demand for power, for copper, for all the raw materials needed to build out this AI infrastructure is so enormous it could literally spark a whole new wave of inflation all by itself. Second, there's credit risk. This historic build-out is being paid for with massive amounts of corporate debt. If those big AI profits don't show up as quickly as everyone hopes, all that debt could become a really serious problem for the whole financial system. Which leaves us with the critical question. Is this AI rally a rocket ship fueled by genuine innovation, or is it a vehicle running on debt, with a supply line that's starting to sputter?